It's 1929, and the stock market is roaring with excitement. People are making fortunes overnight, but you can't shake a nagging question. What if it all comes crashing down? Amid the frenzy, one man stands apart, Benjamin Graham. While others chase trends, Graham focuses on a different strategy, investing based on solid principles and protecting against the market's wild swings. His approach is a beacon of reason in a sea of chaos. Today, his groundbreaking book, The Intelligent Investor, offers timeless wisdom on navigating the financial markets. Ready to discover how to invest wisely and weather any storm? Join us as we explore the principles that have shaped the investment world for decades. Part 1. Introduction to Benjamin Graham and Value Investing. Benjamin Graham, often called the father of value investing, laid the foundation for a rational approach to investing. His philosophy centers on buying undervalued stocks and bonds and holding them for the long term. Graham's investment principles are designed to minimize risk and maximize returns through disciplined analysis and a focus on intrinsic value. In The Intelligent Investor, Graham emphasizes the importance of understanding the difference between investing and speculating. Investing is about making decisions based on careful analysis, while speculating involves making decisions based on market trends and emotions. Graham advocates for a systematic, rational approach to investing rather than chasing after the latest market fads. Part 2. Investment versus speculation. Graham opens the book by defining the critical difference between investment and speculation. He argues that true investing involves thorough research and a focus on the underlying value of an asset. Speculation, however, is akin to gambling. It's driven by market trends and the hope of quick gains rather than a solid understanding of the asset's worth. The core of Graham's philosophy is the concept of intrinsic value, the real worth of an investment based on its fundamentals. An investor should always seek assets that are priced below their intrinsic value, providing a margin of safety. This margin helps protect against errors in judgment and market volatility. Part 3. The impact of inflation. Inflation is a persistent threat to your investment returns. Graham discusses how inflation erodes purchasing power and affects long-term investment outcomes. To combat inflation, he suggests investing in assets with growth potential, like stocks, rather than relying solely on bonds or other fixed-income securities. Stocks, with their potential for growth, can provide returns that outpace inflation. Graham advises investors to balance their portfolios to include assets that can grow and offer protection against rising prices, ensuring that their investments maintain their value over time. Part 4. Historical perspective on the stock market. Understanding the historical context of the stock market is crucial. Graham takes us through a century of stock market history, highlighting its volatility and long-term growth. He explains that the market goes through cycles of booms and busts, and it's essential for investors to manage their expectations accordingly. By studying past market behaviors, investors can better prepare for future fluctuations. Graham stresses that while the market can be unpredictable in the short term, a disciplined, long-term approach will often yield positive results. Part 5. Defensive versus enterprising investors. Graham classifies investors into two categories, defensive and enterprising. Defensive investors are those who prioritize safety and minimal effort. They invest in a diversified portfolio of high-quality bonds and large-cap stocks. Their goal is to preserve capital and achieve steady, modest returns without actively managing their investments. Enterprising investors are more proactive and willing to conduct extensive research to find undervalued stocks and opportunities. They have a higher risk tolerance and seek to achieve higher returns through active management and careful selection of investments. Both types of investors can succeed, but their strategies and risk levels differ. Understanding which category you fall into helps tailor your investment approach to match your goals and risk tolerance. Part 6. The Value Investor's Toolkit. Graham provides a toolkit for value investors, emphasizing the importance of analyzing a company's financial health, earnings potential, and future growth. He introduces the concept of buying stocks at a discount to their intrinsic value, a practice that provides a margin of safety. Key tools for value investing include evaluating financial statements, understanding earnings power, and assessing management quality. By thoroughly analyzing these factors, investors can make informed decisions and avoid overpaying for assets. Part 7. The power of diversification. Diversification is a cornerstone of risk management. Graham advocates spreading investments across various asset classes and industries to reduce the impact of poor performance in any single investment. A well-diversified portfolio typically includes a mix of stocks and bonds, with allocations adjusted based on your risk tolerance and investment horizon. Diversification helps cushion against market volatility and enhances the stability of investment returns. Part 8. The role of bonds. Bonds are an integral part of a balanced investment portfolio. Graham discusses the importance of including high-quality bonds to provide income and stability, particularly during periods of stock market volatility. Investors should focus on bonds with low default risk and appropriate maturities to match their investment goals. Bonds can offer a steady income stream and reduce overall portfolio risk, making them a valuable component of a diversified investment strategy. Part 9. Navigating market fluctuations. Market fluctuations can test an investor's resolve. Graham introduces Mr. Market, a metaphorical figure representing the market's irrational behavior. Mr. Market offers prices that fluctuate wildly, driven by emotions and short-term news. Investors should view Mr. Market's offers with skepticism and maintain a rational, long-term perspective. By sticking to a disciplined investment strategy and avoiding knee-jerk reactions to market movements, investors can make more informed decisions and achieve better outcomes. Part 10. Implementing the margin of safety. The margin of safety is a fundamental principle in Graham's investment philosophy. It involves purchasing investments at a significant discount to their intrinsic value, providing a cushion against potential errors and unforeseen events. Graham illustrates this concept with practical examples, showing how to assess the intrinsic value of stocks and bonds and why buying with a margin of safety is crucial for protecting your investments and ensuring favorable risk-reward ratios. Part 11. The Intelligent Investor's Philosophy. Graham wraps up by reinforcing the importance of a disciplined, rational investment approach. He emphasizes patience, thorough analysis, and a focus on long-term value rather than short-term gains. The intelligent investor remains calm amidst market turbulence, adheres to a well-thought-out strategy, and continuously seeks to enhance their knowledge and skills. By following these principles, you can build a resilient investment portfolio and navigate the complexities of the financial markets with confidence. Thanks for listening. If you found this summary valuable, don't forget to give it a like and subscribe to our channel for more.